Okay, so hopefully everybody is able to view the slides. Not sure if you are watching, on your computer or your phone, but we're gonna get started. And I'll introduce myself. I am Adina Martin. I'm a real estate agent, realtor with Sampson Properties. I've been an agent for about 6 years. I love it. I service DC, Maryland, and Virginia, and first-time home buyers. That is really my first love. So I do work with sellers, but I love the education piece of it. So looking forward to getting you guys informed and getting starting on their journey to home ownership. Alicia, if you want to go.
Sure. Good evening, everyone. Again, thank you for joining us. My name is Alicia Wooten. I am a loan officer with Movement Mortgage. I've been in the business for many years now, and my passion too is the education of first-time home buyers. I think it's a joy and a privilege, honestly, to work with first-time home buyers to educate them in regards to probably the biggest thing they'll ever purchase. And we do a plethora of things here, but first-time home buyers is my heart as well.
Awesome. So we're going to get right into the slides. Um, okay. So talking about the current market activity and interest rates. In terms of market conditions, just because I'm kind of out in the field with both the buyers and the sellers, um, we kind of know there's a lot going on in the world, right? So interest rates are doing a thing, which Alicia will talk about. But I am seeing there was an influx of buyer pre-approval. So folks were like, okay, the rates are pretty good. Let's get into the market. That slowed down a bit. I will say those properties that are really nice, the seller has done their work, it's turnkey ready. Those are getting multiple offers in some cases, maybe three or four. And this is just the spring market. So I always tell people this spring market is a little slower than some before just because of, other dynamics that are impacting the market. But normally, your spring market and summer, those are very fast-paced markets. They're competitive. You have to really kind of have your ducks in a row, and really know what you're going to move forward with to purchase because it's very competitive. You just kind of you need to know.
Mhm.
Alicia, if you want to jump on rates.
Yeah. So the market right now is very volatile for many reasons. Interest rates are governed by the Federal Reserves, and Mm, there's a bit of a stagnant kind of we were trending down before we kind of got into some of the things that are happening in the world today. And as you can see, prices are going up. I mean, I saw gas prices go from like $2.92 to like $3.90 overnight. And because of what's going on in the world right now, there's a lot of tension around finance, around cost of everything, and interest rates are included in that. Um, as we can, as Adina said, we were kind of fluctuating more towards a buyer's market because people were getting used to, okay, well, no, 3.5, 2.5% is probably not going to be ever again. So let me go with this 6% interest rate. We really were trending more towards even like a 5.75, a 5.99 at some point. But now, again, because of what's changing in our world, everything is tight. Things are going up because we've got to pretty much in the industry and in the world in general, as grandma might say, rob Peter to pay Paul. We kind of just kind of got a grip on everything and it's not loosening up. That should make you afraid though. That shouldn't make you afraid because the way I see it is that if you can buy in a market like this, knowing that this is temporary, knowing that things are not going to continue to go on an incline so fast, if you can buy in a market like this, when things do become normal again, you'll be in a better position with the finances you have. Why? Because you bought when it was tight, and now that it's loosening up some, you have more room in your mortgage payment. You have more room to save. Rates are right now anywhere on, there's different types of loans, but I'll say on an average about 6.1 to 6.2%. And even still, that's a good interest rate. That's a really good interest rate with no points to pay. So, it's not all bad. Really, it's not. We don't pay attention to rate more than we pay attention to payment. If you can afford the payment, don't worry about the interest rate. Okay. If the payment is good for you, let's go with what that is and not be so worried with what the actual rate is. Adina.
Yes, totally agree.
Mhm.
Um, and in terms of that shift that Alicia talked about, us, kind of going to a buyer's market, it depends. It just
Mhm.
depends. You know, um, some homes that are really well put together, that seller's going to have a different experience, but I am seeing buyers not having to waive contingencies that are there to protect them. I am seeing more negotiations happening during inspections, which is good. You want to feel like you're going into a house without any big ticket expenses. So that's a plus. So there is room to negotiate. It's not totally this fast-paced market where it's all for the sellers. There's some negotiation happening at the table to get to the closing table.
And Adina, a lot of that is because a lot of sellers have been waiting, and it's been a year, 2 years where they've just said, oh, well, it's not the right time, it's not the right time. And now it's just like, okay, if we're going to go, we're going to go. And so that leans toward more negotiation, as you mentioned.
Yep, absolutely. Okay, so the next slide we have is preparing for pre-approval. I'll give it to you, Alicia.
Yes. So the pre-approval process is sometimes it could be a little challenging to understand, and it shouldn't be, but it is. And so we're here today to kind of break that down for you. When you call Adina and you say, I'm ready to purchase a home, the first thing she's going to say is congratulations. And then right behind that is going to be, do you have a pre-approval? A pre-approval is your pass to go and look at houses that you are interested in. It gives you the idea of what you can afford based off of your income, your assets, and your credit. Okay. Your pre-approval is based off of those three things: income, assets, and credit. A lot of lenders will give you what's called a pre-qualification. Now, there's a difference between the two. A pre-qualification is based off of what you tell me you make on your job, what you tell me you have in your bank account, and what you tell me your credit score is. That plus your loan application renders what's called a pre-qualification. But a pre-approval says that you have confirmed by documentation those three things: what you make versus by your pay stubs on your job, what you have in your bank by your bank statements, and a credit report. Okay, I'm going to ask you though, do you know what your credit score is? And it's okay if you don't, but what we'll do is we'll soft pull your credit initially, especially when you don't know what your score is, to find that middle, like where you are. Soft pull only gives you one score, so it wouldn't pull on your credit score when we do that. And we can kind of we get all the things, all the liabilities there, and we can kind of gauge what's going on. But there are tiers, as you can see on the slide, for your credit, okay? A 580 credit score will get you in the door in a lot of cases on an FHA loan, a Federal Housing Administration loan, okay? They will go down to 580, sometimes 500 if you have a large enough sum of assets for a down payment. They're going to require 10% there, where normally it's only a 3.5% requirement, okay? But that 580 score, typically, if somebody has a 580 credit score, there's something more going on the credit report. Okay. There may be recent late payments, there may be judgments, collections, things of that nature. The tiers go from like 580, 620, 640. Then the next jump is a 680, 700. Okay. That 620, that is a definite good place for an FHA loan without down payment assistance, okay? Down payment assistance is going to want you to have a 640 or better. Now, FHA does have a down payment assistance program that doesn't require the 640, but as you know, when there's more risk, the lending institutions are less willing to give more. Okay. So on that FHA down payment assistance, where you might not have the 640, where they're going to require you to make a payment on that down payment assistance back right away. There's no gap in it. Where most down payment assistance gives you, you won't have a payment either for 5 years or as long as you're in the house. The FHA one, because it doesn't require a credit score, they're going to give you that down payment assistance, but you're going to pay it back over a certain period of time right away. So it's better, you have more options when you have a 640 credit score or better, because as we'll get into later on in the slides, there's more opportunity for down payment assistance to open up to you. As you can see here, that your credit scores are based off of your debt management, right? So, we can talk real quick about what that means. You should be no more than 30% over the limit, or your balances should be no more than 30% of what that lender on the credit report has given you. Okay, because when you exceed that 30%, you're then putting yourself in the risk factor through the credit bureaus. There are three of them: Equifax, TransUnion, and Experian. They're going to say, uh-oh, well, Naija is pushing her limit on what she owes us. Is she able to pay? And everything on that credit report has a score, from your name to your social security number to the types of liabilities you have. They're all coded, and those codes derive your three credit scores. So debt management is very important. Don't go over 30%. Make sure you pay those bills on time, because if you don't, there's a late payment. And what is that going to do? That's going to drop your score. No co-signing. You can see right here, do not co-sign, because when you co-sign, even though that person may live in a whole nother state and paying that bill, if they forget to pay it, guess what? It's going to show up on your credit report. Okay, so these are things we have to look out for. Set your maximum comfortability level. Know what hinders your pre-approval. And we just went over a couple of things, right? Your pre-approval will be hindered, number one, by that credit score. That's the first thing we're going to look at. That's the first tier we're going. Once we see that credit score, we know then which way to go. Okay. Your income has to be consistent for a pre-approval. You may be a plumber. Let's just use that. If you're a plumber, you can't tell me you're a plumber today and a baker tomorrow. The underwriter is going to want to see consistency, that you've worked in the same line of work for at least 2 years. That is something that the pre-approval process will also look at. And that you make a steady amount of money. You can have more than one job, that's fine, but so long as you've been doing what you're doing for 2 years or more, we can count that income, okay, in the same line of work. And then the last thing is your assets necessarily are probably the least most important, because we can get around a lot of cash to close through down payment assistance, through seller help, maybe even through gifts from family members. But for most programs, you're going to need at least 3.5% down. If you're not doing down payment assistance, which that would shave a lot of that off. In the DMV, your closing costs include down payment. Your cash to close, I mean, includes down payment and closing costs. Those two together run anywhere between 5 to 7% of your sales price. Once you render what that number is, then you can start backing away things that you would have to come to closing with, like the cash to close with seller help, maybe, or like I said, a gift, or even maybe like You can even get a gift from your job that doesn't have to be paid back. There's plenty of programs we can talk about, and I think we'll talk about some later on. That one in particular, live where you work in Baltimore. They'll give you funds just to live close to your job. So these are things that you have to consider in pre-approving. Once that pre-approval is done, which is something I would do, I would review all of your information and then I tell Adina, hey, our client is pre-approved for $300,000. And Adina says, okay, I can go now. We can go out and look for houses within that range. So know the difference between pre-approval and pre-qualification. Two totally different things. And the main difference is documentation. Go ahead, Adina.
And I think what's big about the pre-approval also, we're not going to see houses without it. There's no sense in not knowing what your approved price point is, and you seeing a home that's over your budget. You're not going to be able to submit an offer without a pre-approval. That's a must. You have to have proof of funds. So you need to be able to show that you have a conditional commitment from a lender. Um, but then also, if you don't meet with Alicia to do that work in advance, you might see a home on the market that's beautiful. It's a hot home. You can't move forward on that home until you have a pre-approval letter. So you're going to, you want to be ready. You want to be ready. So pre-approval is the first key. That's the number one thing that we have to start with.
Mhm, mhm.
Okay. Okay, so the next one is affordability and timing. Know before you go. We're talking about that, right?
Mhm.
So, Alicia, if you want to talk about maybe the budgeting piece and the kind of knowing your monthly mortgage payment, the value and what makes that up.
Yes. So the mortgage payment is based off of what we call PITI. It is your principal, interest, taxes, and insurance. Okay. So the principal payment with plus interest is the mortgage payment. But then 99.9% of lenders are going to do what's called an escrow for taxes and insurance. So that way you're not getting a bill from the state or the county that you live in to make a lump sum payment. Your taxes are at a 12th are included in your principal and interest, just like the homeowner's insurance that's required on the house is included at a 12th, meaning that if that premium for the homeowner's insurance is $1,000, well, we divide that by 12 and you'd pay a 12th of that with the principal and interest and the taxes. That those together, all of those together are what equals your mortgage payment. Now, if you're buying a condo, there may be condo dues that are every month. That's also going to be included in your qualification, whatever those monthly condo dues are. Or if you're buying a townhome that has a homeowners association, those two would also be included. So when you qualify, I have a prime example. We've qualified someone for $300,000 and then they go and they want to purchase a condominium that has a monthly condo fee of $500. And in this area, that's real easy. That will knock you out of qualifying of that 300,000. Why? Because when we qualified you based off principal and interest, taxes, and insurance. Now you found this beautiful home now that has another $500 monthly payment. You can't afford $300,000 anymore. Maybe you can afford 250. So we've got to make sure we're budgeting. When you talk with Adina about the typical or the type of house you want, tell her these things up front so that we know, all right, we're trading toward condo. So maybe we need to backpedal a bit on that 300,000 to give you room. The budget is very important when we do that because you don't want to ratify a contract and Adina won't even allow it because she'll send me the property and we'll do our investigation to see if that pre-approval still stands for that particular property, but we don't want you all to have like upset about a house you really like. We can do the legwork up front. So manage that. The pre-approval is for your dream home. It's basically saying making sure you're having a budget for that, making sure you're doing all the legwork up front before you have to be told, no, we can't do this for this particular property.
And just managing, yeah, like doing a lot of the work up front, managing expectations, like have
Mhm.
your must-have versus your nice-to-haves. And even once it's really a process because once you get in, like you're in the market, you're looking at the properties, those can change, and
Mhm.
that's okay too. But, take a step back to kind of assess, what's going to really work for you. And I always tell people, most homes are not your forever home, right? Not your first one.
True.
And so you're going to ideally most buyers stay in their initial home 5 to 7 years before they level up. They want to find something better or bigger.
Mhm.
Um, so just kind of having certain parameters in place, certain ideas, giving that thought, to be prepared to go view different properties and to be a little bit flexible because the market is what the market is. We can't, if sellers are, putting certain type of properties out, that's what's available.
Mhm.
So then you just reassess your must-haves versus your nice-to-haves to see if something will work for you. Um, in terms of a loan estimate, and I do work with my clients regarding this, I'll print a particular property out from the MLS that you say that you like. It might be at the max price point of your pre-approval. It might be in the middle and it might be a low. Like we might get three different quotes so you can kind of see what's really going to be comfortable for you for your monthly payment, but also what your cash to close will look like. And I think that will be like a guide that's really helpful when we're looking at different properties. You'll know kind of your bandwidth with each property in that price point. Okay. We're going to keep going. So, really, this is just a high level overview of the buying process. Um, Basically, you're going to initially, after you have your pre-approval, we're going to actually start doing your home portal search. You'll start browsing different properties based on your must-haves and your price point. Right, the next one you see is called an earnest deposit, right? So with each contract or offer that goes forward to the seller, when you're ready, um, you have to give a what's called like almost like a good faith deposit to show that you're serious about what the offer that you're putting forward and that you're putting a little bit of skin in the game. You're serious about it. And so that earnest money deposit, it will actually go towards or assist your cash to close to be less. So just think about it's not going directly to the seller, it's actually helping you.
Mhm.
Okay. And then after the offer is submitted, the EMD is open in escrow. You're working with a title company. Escrow is now open, which they're going to hold this deposit. They're going to start doing title work. They're working with the lender on financing numbers. A lot is happening behind the scenes. But after that, we move into the inspection period. And that period is negotiated with the seller. When we do the inspection, we're looking for big ticket items. It will even say that in the addendum. It's not for like little small caulking or, little things. What is going to be a problem for you when you move into this house? Is it an HVAC issue? Is it the roof? Are there plumbing issue? Is there water damage? Is there mold? I'm talking about big ticket things that can really be a hindrance for a buyer when they're moving into a home. Those are the things that we're tackling. And now it's not something, you can negotiate during that period. And if it doesn't work, you can walk away without penalty. That's why there's something called an inspection contingency in place to protect you as the buyer. Should something major come out that you're not able to negotiate, you can walk from that property. So that protects your earnest money deposit that was put forward so that there are no damages and you can have that returned. Okay. And then after your inspection, That's been negotiated. We're moving into the appraisal process. I'll say, Alicia, we just wrapped up the inspection negotiations. They're ready to move forward to the appraisal. Alicia normally puts in an order for the appraisal for the home. An appraiser comes out and gives their opinion of the value of the home by looking at market comparables. They're going to give their best estimate on what the value of that home is based on that data. And if everything goes well, we continue to move forward. If there is if the appraisal comes in short, so say you offered 315, but the appraisal came in at 305, you'll have an appraisal contingency in place that will say if it does not meet the offered price point, we are requesting that the value be adjusted according to the appraisal. And the protection there again is for you as the buyer. If they don't agree, you can walk away without damages. The seller can also have an out if you're not able to negotiate that change. There is something called an appraisal gap, which I don't recommend. I don't think it protects the buyer. There are some people who really love a home, and I've had that experience where they pay the difference. Um, of whatever that gap was in the appraisal from the offer price to the appraised price. But, I don't recommend it. And here's a key thing when you're talking about appraisals. Me as your agent, when we're going out and you're telling me you like homes, I'm checking comparables. That's a big thing, because we don't need to see a home that's not priced accurately. We know offhand that there's going to be an appraisal process. There's going to be a problem. So I'll reach out to the listing agent. Hey, where did you get what comps are you using? Because what I'm seeing does not match. Or this is really kind of priced a bit high from what I'm visually seeing, the condition of the home, the price isn't matching. So there's homework that I'm doing on my end to make sure that we can have a smooth transition through the buying process. And then, Alicia, do you want to talk about what kind of happens on the in-between time, what you're doing?
Yes, yes. So while all that's going on about the property, um, we talked about a little bit about everything else as far as the credit qualifying is concerned. The credit qualifying piece is all the buyer, okay? Has nothing to do with the property. Everything Adina just discussed with the title work and the property and the inspection and the appraisal is all property, all seller, okay? If something falls out with those things, not your fault as a buyer. But what's happening at the same time those wheels are turning is the underwriter reviewing your credit, your job information, your assets. If there's any cumbersome things that are going on, like for instance, if someone is receiving child support, or has to pay child support. There are different things, and it's all different per loan. But while the property portion of the loan is moving, so is the credit piece, and that's all us. That's all buyer. Buyer has to make sure that they're keeping in contact not only with myself and Adina, but also with the other parties that are involved on the credit side, which would be a loan processor. That's the individual who takes your loan after Adina and I have worked it up and got everything all pretty and tied up in a bow. You'll speak to an assistant that puts the loan into processing. That assistant and that processor work directly with the underwriter. That's someone you'll never speak to, okay? The underwriter has to see black and white. They can't see gray. They read off of guidelines. Whatever guideline, whatever program we say you qualify for, they're reading line by line to make sure you qualify on the credit side. They don't care if the dog ran away and you had to take the dogs somewhere else, and they don't care about any of that. They don't feel. They look directly at the guidelines. It's our job, Adina and myself, and the processor and the assistant to speak to you to know exactly what's going on so that we represent you well by documentation in front of the underwriter. So the property piece and is the seller and the credit piece is the borrower. All of that comes together in the form of a conditional commitment. And a conditional commitment says Nigel can buy this house so long as we get these conditions before closing. there's a list of conditions that come that are property and title related and that are credit related. Those credit related conditions can be something like, I need an extra bank statement, or explain to me why your pay was low on this pay stub and not on this one. Those are things we'd come back to the buyer for. Once all those conditions come together, that processor is going to package everything back up that the underwriter asks for, send it back to the underwriter. The underwriter will review and maybe come back for something, because sometimes more documentation can provide the underwriter the ability to ask for more information. So that's kind of a toss back and forth until the underwriter is comfortable with saying the loan is clear to close. Once that loan is clear to close, there's no longer a conditional commitment, but it says you can go to settlement and get the keys to your property. At that point, we're still not done, because that conditional commitment that went to a final approval, now your file goes to a closer. And the closer is the individual who speaks directly to the title company to make sure all the fees that the seller owed, all the fees that you owed match up, and whatever that cash to close is accurate. Once that happens, which is anywhere typically between 3 to 5 days before settlement, then you go to closing and get the keys to the property. And that's pretty much how it goes.
Yeah, and I always tell, people who are looking to potential clients that are looking to purchase, your lender is your best friend. They are there to help you get financed and to see you all the way through. Any type of financing questions, and I can help to a degree, but I am not the finance specialist. So I am your best friend on looking for looking out for your best interest when it comes to the property. The person that is going to help you really get to close, that's going to be your lender. So just know that we work as a team to get you to the closing table. All right, so let's jump into the next one. Okay, so now this is a preparing to sell, and not even sure if this is necessary to go through, but because Naja, you might just be looking to buy. I will say from the sell side, what might be valuable for you is just kind of like understanding the steps of what we do when we're working with a seller, when we're having a consultation with them, if they're a good agent, you know. They should be doing a thorough consultation with that client. They should be running comps, comparables as well, so that we know that we're pricing according to the market value. Doing an honest assessment with the client also to make sure that any repairs, if they can be done in advance, if that, seller has that liquid to make those repairs. But then also there are programs that will do repairs and then they can pay those at closing. So there's always, if you have a creative agent, they can make sure that those things happen and to keep the deal going instead of, okay, well, the seller can't do it. Okay, well, the buyer's going to walk if that can't be repaired. You got to have, tools in your toolbox to help both clients. And sometimes you even have to work with the listing agent to make sure, hey, if you don't have that, here's this resource. Call them so we can get to close. Everybody needs to make sure that we have the priority, the goal in front to get the home sold and to get both of you all to the closing table. Okay, so those are just kind of some of the things in terms of listing prep strategy that I will normally go over um, with potential sellers. You see this right here where it talks about financing and negotiation, like assumable loans and contract strategies. Alicia, if you want to touch on assumable loans, because I do think that's really beneficial, not just from a seller being able to sell their property at a lower interest rate, but how that impacts the buyer.
Yes. So basically, what an assumable loan is you are taking the current mortgage that the current owner of that property has, and it's being transferred to you. There is you still need to qualify, but at the same time, you're not creating a whole nother mortgage payment. So whatever, and the reason why people do this, one is because mainly because of the interest rate. There's a lot of sellers now that have interest rates that are very low. Okay. And I've seen multiple times in listings, this is an assumable mortgage. So that means that whatever that lender requires of you to make sure that you can assume the mortgage, I mean, take over the mortgage, you qualify with that lender. So, in other words, if it's Citibank or City Mortgage or whatever that has that mortgage on that property that you want to purchase, you still go through the contract the same way you would mostly with Adina, but then instead of calling your own lender, you then now have to qualify based off of what the current mortgage is. Okay. I see this a lot with VA. It happens a lot with VA, but it does also happen with regular traditional mortgages as well. And it is very beneficial, actually, to both the seller and the buyer because, hey, you can get in on maybe a 3-4% interest rate if you qualify versus going the traditional way and qualifying for a today's interest rate. So check those listings out when you're looking to see, is this mortgage assumable? And Adina may even ask that question if you're concerned. And if you can't qualify with a 6.5%, maybe you can qualify with a 4% interest rate. Go for it. Go for it, you know?
Alicia, with the assumable loan and that criteria,
Hmm.
um, there's often an amount in terms of the equity
Hmm.
that a buyer will have to bring a certain amount of cash to the
Absolutely.
table.
And so with assumable mortgages, thanks for bringing that back to my remembrance. You will be putting more money down versus on a traditional financing loan. Like we said before, FHA may require 3.5%. Sometimes assumable loans could be anywhere between 10 to 20% to
Hmm.
20% of, if you have it, fine. But you see, we talked about risk earlier. So when someone gives a little, you got to give a little. They're not
Yes.
gonna, if you're getting in on a low interest rate, well, no, you got to come with a more of a down payment than you would if you went with a 6.5% interest rate. So it just really all depends on the individual, what their current situation is, if it will work for them. Yeah.
Okay. All right. I kind of touched on this already. Just this is basically renovation and marketing. This is a slide in terms of marketing strategies that are used to draw in buyers. And
Mhm.
then there's the program for sellers, again, that there is always an option, right? You can either get your home repaired and renovated prior to listing, or if there's a negotiation and the buyer is willing to kind of, if it may extend the contract a little bit to make sure we get those certain things repaired, there's always an option. So I have a lot of good toolkit, things and tools that I have in my toolbox. Okay, and this brings us really, we're almost kind of done. We wanted to briefly go over the process and then kind of touch on some of the popular programs that are available. Keep in mind that, again, Alicia needs to look at your personal individual financial portfolio, say what program is going that she can even recommend, so we don't go too far in depth with these because we know that everyone is, has different circumstances. But I'll shoot this over to Alicia if you want to touch on.
Sure. And so we talked about down payment assistance. Now, what I want to say, and a lot of times people hear down payment assistance and they go, "Oh, it's free money." There's always a stipulation. There is a difference between down payment assistance and a grant. A grant you don't have to pay back. That's free money because you wear red glasses. You get the grant for red glasses. Okay? That money doesn't have to be paid back in most situations with a grant. But down payment assistance is basically saying to you, okay, I'll lend you this money to get in your house, but at some point, in time, based off of which one of these programs you go with, there's a possibility you're going to have to pay that money back. Prime example, Maryland Mortgage Program. Everybody hangs their hat on the Maryland Mortgage Program. Adina will tell you for a long time, I didn't like the Maryland Mortgage Program because I felt like, well, the what they do is they give you up to 5% of your sales price. I'm sorry, up to 5% of your loan amount. They're different. They don't go off the sales price, they go off the loan amount. So whatever that sales price is, the difference between that, your loan to value, they'll give you that loan amount 5%. Okay. They give it to you up front with no payment ever, unless one of three things happens. You want to sell your property, you got to pay them back that 5%. You want to refinance your property, you got to pay them back that 5%. Or if 30 years passes and that mortgage, that first mortgage is paid in full, you got to pay them back their 5%. Okay. There's no payment on it. So a lot of times people that have a debt to income ratio problem, Maryland Mortgage Program all the way to go because there's no payment, there's no immediate payback on it. Okay. Good program if you feel like you'll never want to move, which most people, that's not really so. But at the same time, within 5 to 7 years, let's say, I've gained some equity. So, and I've kept my credit good. So maybe I will refinance because now that $1,500 they gave me, I've gained that in equity now. So I can refinance my property and pay that off. Otherwise, Maryland Mortgage Program sits on your deed for at least 30 years until it's time to pay it back. Okay. Okay, program. I'm not knocking it. We use it all the time, but sometimes there may be a better option for you. The USDA loan is basically a loan that it gives a certain percentage off a down payment, like a help off. I can get 100% financing pretty much through USDA, but you have to buy in specific areas. It's a rural development program that says we want more people to come to these areas in our state. So we'll give them 100% financing, which now you don't have a down payment, you only have closing costs. So that 5 to 7% we talked about now, maybe 4%, and you definitely can get that, part of that at least from the seller. So USDA is a very good program if you're willing to move it to the outskirts of city. It's not a city program, it's rural area that they lend to. This pathway to purchase is another hot one that people really don't focus a lot on. And the reason being is because of the length of time it takes with the program. Okay. Most sellers want to see you close on a contract or you send them a offer within 30 days of that offer, they want to go to settlement. Not so with Pathway to Purchase. Pathway to Purchase puts a pretty price tag on their down payment assistance up to $50,000, depending on what you need. Okay. Up to $50,000. They do go off a household, how many people are in the household, who makes money in the household. They will, but that $50,000 can go a long way if you find a seller that's willing to accept an offer that extends past 30 days more toward 45 to 60. So that's something that if you know that you're going to need down payment assistance, and once we go through the pre-approval process, before you ratify a contract on Pathway to Purchase, you and I would raise our hand and tell Adina, hey, we need a lot of money for down payment assistance and we need Pathway to Purchase. So whatever houses we're looking at, we need a seller that's willing to wait. And some of them are. Some sellers don't mind. They'll stay in their house, for however long as they know it'll close. So that's a good one. I'm gonna let Adina talk about Virginia housing, but then there's also I see here the zero down in your house what is zero? I can't see that, Adina. What is it? Zero.
Zero down in-house programs that,
Oh, yes. So
yep.
we talked about that. The FHA program is also so they'll give you 5%. Now, 5% is 3.5% toward what FHA requires, right? They require that you put down 3.5%. As long as you have a 580 credit score or better, the down payment is 3.5. They give you that. It's part of the 5%. The other 1.5% they give towards closing cost help. And that's an in-house program where we call it the FHA Boost program, okay? And that's one that will have a payment right away. And typically that payment, depending on your sales price, can run anywhere between 80, I've seen as much as $140 a month. I don't think that's bad because the difference between that one and MMP is that this is paid off in 10 years. At 10 years, you don't have a second mortgage sitting on your deed anymore. Why? Because you've paid it back right away. That works. There are other in-house programs like for first-time home buyers that are not even don't even necessarily have to be a first-time home buyer, but doctors programs or first responders programs where you can get money off because you're a teacher, because you're a nurse, because you're a police officer, military, first responders. There's also like the doctors program. If you're in some type of internship, you can get almost up to 100% financing. And then the bridge program is also a good one. This one might not pertain to well, it doesn't pertain to first-time home buyers. Actually, it's for the seller who wants to move out before they find a buyer. And it's basically kind of like there's equity in the property, so they leverage the equity as down payment assistance to the next property until they find a seller, a buyer. And there's a time constraint on that as well, but it's an option. And Adina, you want to touch on Virginia and Baltimore?
Yeah, sure. So for Virginia Housing, um, this is a great program.
Mhm.
I really think it has MMP beat. I think
Yep.
it's just I actually just did a refresher course because you have to be called what's train the trainer, and we're not technically able to really go deeply into this unless we're doing a certified session.
Correct.
So they
Hmm.
don't even let us do that online, but this program definitely has grants for first-time home buyers. They call them bonded or non-bond programs. With that, you can also stack county grants with that as well. I mean, it's just tons of money that it's a little bit unbelievable. Some don't have to be paid back either. So I think a lot of people, there are income limits for those particular ones that are grants, and there are targeted areas. For purchase, just like USDA too, and they have a map. So if you're on the Virginia side, that would be a whole process, and there is a actual kind of like a pre-qualification that you have to go through, um, attend an actual in-person training or take an online training that they offer. It has to be HUD approved. There's some things and steps that you have to do, but I think it's worth how much they're going to give to you, and you don't have a second lien. I mean, that's really big. And then Baltimore City, we don't have enough time to talk about
Oh,
Baltimore.
so many.
They have so many programs. They're looking out for people in the city.
Yes.
Um, they just really do. They have the trolley. They have Baltimore homeowners incentive. I mean, there are so many programs. We've helped quite a few people who have moved from this area to Baltimore, and
Hmm.
more are moving. It's just way affordable.
Hmm.
Um, they are trying to, and I know in the coming years they do have a new redevelopment plan. So, things are shifting. And that's a good thing for Baltimore. So, again, there are tons of programs. Which one is going to fit you will be based on that conversation and, your intake with Alicia to kind of determine, what your options are based on what you tell her. And I will say, going through the pre-approval process and underwriting it can feel intrusive, but they're giving you a lot of money, so go with it. Just go with it. Get your house. But people kind of, oh my God, they're asking me this, but they need to know. We don't want anything kind of jeopardizing you getting to close. We need to know so we can help you. We have to know.
Hmm.
So just look at it like we're your A team. And so we're here
That's
to get you
right.
to closing. Naja, do you have any questions? I know it's a lot of information.
She may not be able to take herself off mute.
Possibly, and or driving or working,
Hmm.
folks.
Hmm. True.
Um, No worries. Anything else you want to touch on, Alicia?
No, I think we went over a lot, and I think it was pretty beneficial. I hope it was beneficial at least. Um, but yeah, I think we're good.
Okay, so I think for kind of just like next steps,
Hmm.
I do plan to reach Nigel. I will reach out to you. I'll reach out to others who were on the call. Just kind of like, you know, find out what your goals are, your time frame, and then Alicia and I will kind of see how we can map, make a plan and a strategy to get to, where you want to be. Okay, now just no questions at this time, no worries. And definitely feel free to reach out. I will do a follow-up email that will include a buyer's guide, and it will have both Alicia and I information. So we want to thank you so much for making time to join
Yes.
this evening. And again, if you have any questions, definitely don't hesitate to reach out. We really, people are closing, people are getting their homes. People who really don't believe that they can be a homeowner, they're getting there. We're getting them there.
Hmm.
So, we're here as a team and here to support you.
Indeed.
All right, amazing. Okay, great, great. All right. Well, Naja, also, I think you provided your email address. You will be getting a gift card. Okay. So they
Yay!
missed out because they logged off early. You're gonna get your
Oh,
prize. But
oh,
thank
that's
you so
great.
much. All
Yes.
right. Thanks, Alicia. And we're gonna
Thanks,
get the ball
Adina.
rolling. Yep.
Yes, right. Y'all have a good night.
All right, you too.
Okay, now. Bye-bye.
Bye-bye.